And now the moment you've been waiting for. I'm going to talk about how precious metal does not just sit there as an unproductive asset gathering dust, as Warren Buffett claims. It is lent out at interest. It is another factor supporting that gold is money. In this video, I'm going to read passages from the LBMA guide directly because I think it will have a more dramatic effect hearing directly from the authority that metals are lent at interest. I'm going to only hit the highlights because otherwise the video would be quite long. I will not read their description of forwards, swaps, repos, and options directly because they make the subject fairly complicated. I will cover that in another video with plain words and illustrations. With that said, here goes. It is often blithely asserted that precious metals have no interest rate. This is incorrect. The rationale for lending and borrowing metal will vary between gold, silver, platinum, and palladium. However, very broadly speaking, lenders of metals will be seeking a return on their investment, whereas the borrowers will have a variety of motives. These can range from miners seeking to hedge future output to industrial companies borrowing platinum and palladium that will be turned into catalytic converters before being installed in a petrochemical plant. Clearly, the range of motivations is far wider than those listed above, but the calculation on deposits and leases remains the same. For example, a fiberglass manufacturer wants to borrow 2,000 ounces of platinum for a year to use the metal in an industrial process. For illustrative purposes, if it is charged an interest rate of 4% and the day count is exactly 365, then the calculation for the interest owing at maturity is simply 2,000 times 4% over 360 times 365 equals 81.111 ounces. At maturity, the loan can be rolled over, depending upon credit considerations, either with the existing lender or with another bank. The lender has full credit exposure to the borrower over the amount of the loan, the currency value of which will fluctuate as the underlying metal price increases or decreases. However, it is unlikely that the fiberglass manufacturer will have ready access to additional platinum, saved by buying it, to repay the interest, and may not be willing to accept the unquantifiable risk of being effectively short platinum for a year. Therefore, the loan is likely to be converted from one where interest is payable in metal to one where it is payable in currency, on the basis that the manufacturer is more likely to have access to currency than metal at the spot price at inception. Using the same numbers and example, a fiberglass manufacturer wants to borrow 2,000 ounces of platinum for a year to use the metal in an industrial process. For illustrative purposes, if it is charged an interest rate of 4%, the platinum price is $1,000 per ounce and the day count is exactly 365, then the calculation for the interest owing at maturity is simply 2,000 times 1,000 times 4% over 360 times 365 equals $81,111.11. At maturity, the loan can be rolled over, depending upon credit considerations, either with the existing lender or with another bank. The lender has full credit exposure to the borrower over the amount of the loan, the currency value of which will fluctuate as the underlying metal price increases or decreases. However, the manufacturer has certainty over the amount of interest owing at maturity. Obviously, this could equally be priced in euros and so on. In a low interest rate environment, there is generally no difference in the rate as to whether the ultimate interest is to be paid in currency, such as US dollars as in the example above, or in the metal itself. Indeed, it is unlikely that the fiberglass manufacturer would have the ability to pay 81.111 ounces of platinum in interest. It would also expose it to price movements in the value of platinum, which may well be undesirable from its point of view. Therefore, as is illustrated above, it is much simpler for the lender to translate the loan into US dollar equivalent and for the borrower to settle the interest charge in US dollars, or Japanese yen, or euros, etc. However, it is generally true that the principal, the 2,000 ounces of the metal in this example, will be repaid in metal. The rationale and impact on the rate levied for whether interest is repayable in currency or commodity is dealt with later in this section. It is not possible to lend allocated metal. Allocated metal is associated with specific bars in an account, and clearly, it is not possible to lend specific bars and expect to get the same ones back while receiving a return. In the same way that no one would be interested in a currency loan, which the requirement was to hand back the exact same banknotes as were originally lent. Therefore, allocated metal becomes unallocated when it is lent, but it can be returned as allocated, albeit it will be returned with different bars and will likely be a slightly different weight. The single grouping with the greatest concentration of allocated metal is the world's central banks and the stocks of gold that they hold. Some of the stock will be held domestically, some will be held in the Federal Reserve in New York, while the major proportion is likely to be held in the vaults of the Bank of England in London. Indeed, its vaults held in excess of 163 million ounces of gold, equivalent to some 5,080 tons as of March 2017. For the latest data, please see the Bank of England's website. It should be noticed that all of the gold held in the Bank of England is allocated. No metal other than gold is held at the bank. The role of the Bank of England in the market is dealt with at greater length in Section 12. However, one of the primary functions of the bank is as a custodian for the UK government, central banks, and certain commercial firms. To reiterate from Section 7, the Bank of England primarily offers gold accounts to central bank customers and to certain commercial firms that facilitate, either directly or indirectly, access for central banks to the liquidity of London's gold market. As of July 2017, it has been calculated by the World Gold Council, using data from the International Monetary Fund's International Financial Statistics, that the world's central banks hold 33,399.2 tons of gold. A listing appears in Section 22. The most recent version of this data can be found on the World Gold Council's website. If a central bank wishes to lend its gold, it will source a deposit rate from a commercial bank and agree to lend the metal, assuming that the rate is acceptable. Implicit in this dialogue is that the central bank understands that it will not be returned the exact same gold bars that it lent out, and that while it previously had no credit risk, with the metal having been held allocated at the Bank of England, it now has an exposure in the full amount of the deposit to the bank to which it lent the metal. Interest rates for currencies are generally determined by a combination of the actions of the relevant monetary authorities, plus transactions of key players in the global financial markets. For precious metals, the scenario is somewhat different in that there are no monetary authorities that seek to set or even influence interest rates for the precious metals. Hence, supply and demand tend to be the overwhelming defining factors. For gold, the perception is that there are sufficient above-ground stocks, mainly those owned by the central banks, to prevent metal rates from spiking above those of the US dollar, and so gold is almost inevitably in contango. The PGMs, platinum and palladium, are throughout this guide, the PGMs referred to, are primarily industrial metals. There are very few above-ground stocks, and hence there can be a premium required for immediate delivery, if needed to create catalytic converters, for example. Therefore, depending on market circumstances, it is not unusual for platinum and palladium to trade in backwardation. Silver, being a form of hybrid in having industrial uses as well as being a widely desired investment, generally spends more time than gold in backwardation, but less time than platinum and palladium. Given the predominance of swaps being traded rather than deposits or leases, due to their more advantageous credit treatment, it is these transactions that will determine the overall level of metal interest rates. Earlier in this section, it was mentioned that in a low interest rate environment there would be little, if any, difference on whether the interest was paid in metal or currency. However, this is not the case in an environment where interest rates are high for currencies but low for metals. In other words, when there is a large contango, greater premium for forward rather than spot sales. For example, central bank lends commercial bank 100,000 ounces of gold at 0.5% for 12 months. The interest earned in gold would be 100,000 times 0.5% over 360 times 365 equals 506.944 ounces. If this was monetized at the spot price of $1,200, for example, then the central bank would receive $1,200 times 506.944 equals $608,322.80 in interest at maturity. However, by the same token, the central bank would know that in 12 months' time, it would be receiving 506.944 ounces of gold as interest. Therefore, instead, it could elect to sell that gold in an outright forward basis, continuing to assume rates that are enormously out of line with the current market environment for purely illustrative purposes. Then, if the 12-month rate for US dollar deposits is 10%, this would give a theoretical swap rate of 9.5%, which is 10% minus the cost of borrowing gold, which is 0.5% in this example. Thus, the central bank could sell the 506.944 ounces of gold at $1,200 plus 1,200 times 9.5% over 360 times 365 equals $1,200 plus $115.583 equals $1,315.583 per ounce. This would then equate to 506.944 times $1,315.583 equals $666,926.91 in interest, an increase of $58,594. Hence, deposit and lease rates will differ in more extreme rate environments depending on whether interest is to be paid in metal or currency. So there you have it, everyone. Precious metals are lent at interest. For you and me, precious metals act as savings. For those who are able to partner up with the bullion banking system, precious metals are an investment where the mass of metal acts as loan principal and interest is generated either in metal or in currency. Even the central banks participate by lending commercial banks metal. But why would commercial banks want to borrow metal? The answer is that they can profit from transactions with others when metal is required. More on that later. But for now, just be aware that precious metals can be investments when they are within the bullion banking system. Hey Warren, are you watching?